The Harmony funds are majority allocated to actively managed equity strategies, in each case with a bias towards the home region. Depending on the risk profile, equity strategies represent 40 to 65% of the funds. These holdings are then balanced with fixed income investments with a bias towards corporate credit, as well as listed infrastructure and listed real estate holdings. We've been quite active with our asset allocation changes so far this year. Remember, back to the start of the year, we were presented with a great opportunity to add to our particularly equity and credit investments at great valuations. We did so in February, and then after a strong rebound in markets, we then unwound some of these increases in April. These holdings continued to perform very well throughout the second quarter, even after the UK referendum result, which we would expect to increase market volatility quite substantially. Therefore, we took the opportunity, just after quarter end, to reduce our equity holdings across the funds by 3 to 4%, primarily by reducing our UK equity and listed infrastructure holdings. All of the Harmony funds were up in the second quarter, net of fees, in their base currencies. The Asian and European funds gained 0.3 to 0.4%. The US dollar funds gained 0.7% in the case of growth and 1% in the case of balanced. And the Australian dollar growth fund was up 3.6%. The best performers, though, were the sterling funds, despite the shock referendum result, with the balanced and growth funds up by 4 and 4.1%, respectively, in sterling terms. During the second quarter, in local currency terms, global equities were up 1.3% and global bonds were up 2.8%. While the Harmony funds didn't benefit from the strongest returns, which ultimately came from global government bonds, our other fixed income investments did perform very well. Dollar emerging market debt and US high yield positions were up by over 4%, and our US and UK investment grade credit holdings also gained 3 to 4% in local currency terms. Considering equity markets, the strongest performing developed equity market during the second quarter was surprisingly the UK when measured in local currency terms. This reflects the fact that the majority of FTSE 100 sales and earnings actually come from overseas, and therefore share prices rose after sterling revalued at the end of the period. That explains a lot of the very strong performance of the Harmony sterling funds, which delivered their best returns right at the end of the month, benefiting from this effect of having fairly high exposure to those companies that have a lot of overseas earnings, but also due to our unhedged overseas investments across equities and fixed income, which really highlights the value of diversification within portfolios. As was also the case in the first quarter, the best performing holding across all the funds in the second quarter was the iShares Gold Producers ETF, up 35% in dollar terms and 46% in sterling terms. This sector also benefited performance of the Copernic Global Equity Strategy, which has a substantial holding in the area. Their fund outperformed by 21% versus the MSCI World Index over the period. Other holdings that contributed notably to performance included our interest rate sensitive equities, particularly listed infrastructure and listed real estate. On that point, it's worth highlighting that all such investments in infrastructure and real estate are invested in listed equities and/or closed-ended funds, which are highly liquid and exchange traded. The issues currently being faced by UK commercial property funds highlight the risks of holding illiquid assets in open-ended funds, something that we have never signed up for in the Harmony portfolios. We still expect reasonable returns from equity markets, as well as from selected areas of fixed income markets, so that's where the majority of the funds remain invested. However, we're keen to increase diversification within the portfolios. So in May, we added a position in an absolute return strategy, sized at a 2% position across all of the funds. This is an equity market neutral strategy that's looking to harness certain style risk premia within equity markets, such as value, quality, and momentum factors. We expect this strategy should be able to deliver good returns, but critically in an uncorrelated fashion from pretty much all of the other holdings within the portfolios. Very importantly, this is a low-cost, transparent, and highly liquid investment, and these are characteristics that we will absolutely pursue for any other strategies that we might look to add in this alternatives component of the funds. The recent Brexit vote has led to a lot of uncertainty in markets, and we think that will keep markets quite volatile going forward for a fairly sustained period, at least until there's some clarity around what Brexit actually looks like, some months or years down the road. A lot of the fears stemming from this have been priced into markets. Markets have been surprisingly resilient post the result, but certain areas have been very weak. So overall, we think a lot of the risks are priced in, and there's some potential upside and reasonable valuations. However, given some good performance from a lot of our holdings across the portfolios, as mentioned before, we trimmed a little bit of exposure to equities post quarter end, and that frees up a little bit of cash, which we hope to deploy some time down the road, taking advantage of the volatility in markets, adding to our positions at slightly more attractive valuations.